your perspective, Sam, and from the asset management team, what does it mean when someone talks about diversification, and what are the types of different diversification strategies you put in place based on someone's risk profile?
Yeah, it's a really exciting one to bring this conversation together. We've talked about a number of asset classes, and they're all asset classes that we make large investments in. So we have really good exposure to Australian shares for their growth and for some solid income. We have more exposure to international shares, wonderful periods of return in international markets, as Reuven had indicated as well. We like the balancing effects of fixed income and bond-like, cash-like investments. Private debt, private credit sitting within alternatives also plays a role in our portfolios, through to things like infrastructure and property. And that is for us what genuine diversification looks like across that risk spectrum and across all of those asset classes. For a balanced investor, well, what does that ultimately look like then? It means that you end up with around about 3/4 of your portfolio, 77% in growth assets, assets that are trying to outperform inflation that we were talking about. But that at times, given volatility, a balanced investor does need some defensive assets, those fixed income investments we were talking about. And as a result, around about 20 to 23% would sit in a bucket like that. Through the cycle, this appears to be one of the strongest ways of meeting your retirement objectives over a very long term. Clearly, if you're younger, you may wish to increase your exposure to growth assets and choose a higher growth option. For people in their 50s, balanced appears to be quite appropriate as well. And so we do go through a slow de-risking process where we change that asset mix towards more of those conservative investments that can provide a ballast. But I think the key here is genuine diversification, having a lot of different levers to pull in that portfolio. It's not all about what happens in global shares, because we know Australian shares are working as well. We also know those infrastructure assets with decarbonisation are playing a strong role, investments in essential assets through to large industrial assets within the property asset class also playing a strong role in portfolios.
Thank you, Sam. And obviously us, the three of us kind of talking here today, whatever asset or investment structure you put in has to really match your objectives, your financial goals, your time frame that you've got in the market, and then also your risk profile. There are a number of different ways you can understand and work out what your risk profile is. So it might be 70-30, it might be 50-50, it might be 60-40. Whatever's right for you, it has to align with what you're trying to achieve. And then ultimately make sure you get some advice before you make any significant changes to what you're investing in.